Everybody, and welcome to this week's edition of our weekly coaching webinar. It's been a couple months now since we dove in and talked about financing, and so much is changing so fast around here when it comes to loans and credit lines that I thought it would be a good idea to revisit this topic and to jump in today and talk a little bit more about how to qualify customers for financing. We're going to take a look at the finance suite to look at the process for submitting customers for financing, talk a little bit more about how much you can earn on financing you're getting for your customers, and just talk about a lot of these new loan programs, lenders, etc., that we've been onboarding here over the last few months and weeks. So thanks for coming in. Appreciate you guys joining us. And Marks, thanks for saying hey back to you. Okay, so can your customers get business loans? That's ultimately what we're talking about here. And the easiest way to figure that out, we'll probably dive into more than 25 different ways that your customers can get financing, and of course you as a partner with us have access to these as well. So this is my formula. I call this the 3 C's of lending. It's pretty simple. It's if you want a customer, if you want to know if somebody's going to qualify for money, they need a strength. They need a lendable strength. It needs to be one of these 3 things. They either need to have consistent cash flow, good credit, or they need to have collateral. One of those 3. Now, maybe they don't have good credit, but they have a guarantor that has good credit. Maybe they don't have cash flow for tax returns, but they can verify it per bank statements. Maybe they've only got they want to buy a piece of collateral, not already own one. What it comes down to is that if you have a strength, you become lendable. If you have multiple strengths, you become more lendable with more loan options, as we'll dive into today. So these are always the 3 questions you should ask somebody. What kind of cash flow do you have? What is your credit quality? What kind of collateral do you have? Now, really, what's most important is the first 2. Most people that you're going to talk to aren't going to have the collateral that we're talking about today. And if you ask their industry, you'll quickly know if they have it or not. So usually it's cash flow and credit that will determine, from what we've seen with experience, most of the qualification of your customers. So revenue lending merchant cash advances. Now, this is the fastest, easiest way to get money. It also is the most profitable for you. This is one where you could earn 3 or 4 points, possibly earn thousands of dollars. And funding is usually the same week, within 3 to 7 days. We've seen these deals funded 24 hours. How long they take depends on your customer and how long it takes them to get us what's needed, like the application or the bank statements. So it's really easy money to get. What you'll learn about my 3 C's formula is you only need one of these 3, not all of them. So if you only have cash flow, you can get money without credit or collateral. If all you have is credit, you can get money without cash flow or collateral. If all you have is collateral, you can get money without cash flow or credit. In this case, since cash flow is a strength, well, then you don't need collateral and there are no credit score requirements. We have lenders that don't pull credit with this program. We have lenders that go down to a 500 score. So no matter what the scenario credit-wise, we can help somebody get financing either through a lender that's not pulling credit or one of our normal lenders, which goes down to a 500 or a 520 credit score. That's all that's typically needed for approval is a review of 6 months bank statements and merchant account statements if they have them. More and more lenders are now getting this data electronically where the borrower doesn't even need to supply it. But today, since we work with so many lenders and so many different options, we want to make sure that we get 6 months bank statements, merch statements to have the most amount of option. Now, loan amounts are usually equal to about 12% of the annual revenue. So I like to think of it as 10 to 12%. So if the annual revenue is $200,000 a year, then you've got somebody that's going to get 10 or 12% of that, which is $25,000 with this kind of program. So again, most people in business, most people as consumers want more than they can actually get. Rarely ever do we see people that can get more money than what they actually want. So most people will come in and want well more than they can qualify for, but it makes sense. What it really comes down to is about what they make in a month is about what they're actually going to be able to get lent to them. Now, most of these lenders do daily paybacks, which means that money is deducted every single day from the bank account, and also weekly or monthly paybacks. We have lenders that do both of those as well. So we've had people that didn't want this And when we dive in and find out why, they say, because I don't like the daily payback. We got them a weekly or monthly payback, and they easily accepted the money and they were happy. So just, it's good to know that we have those. These are short-term loans, typically 6 to 18 months. If somebody's lower risk, better credit, better time in business, lower risk industry, good bank statements, they can get up to 36 months. Usually the first time they get this money is 3 to 9 months. To be honest with you, the first time they get money, and oftentimes it absolutely, the terms suck. They're not very good because the person hasn't proven themselves. And then once they come back and they actually prove themselves, then it becomes easier for them to get more money at better terms, usually by the second advance. They get loan amounts up to $500,000. We've seen a lot of these deals fund at $400,000 to $500,000. So it's definitely possible to do that. And most of these people do come back and get more money. So what that means to you is two things. First of all, if you are an executive member and you get paid on funding, you would get paid the first time they get the loan, and every time they come back, you get more and more money. We've got some clients that have come back 8 to 12 times to get money, and the partner gets paid every one of those times. Second of all, it proves how successful this program is. If 7, 8 out of 10 people are coming back and getting more money after they get the first one, then again, it kind of proves of how popular and successful this is. Now, rates are all over the board, 10 to 25%. Time in business, industry, credit quality, bank account management, ending balances, it all ties in to the rate you'll pay. So it's a myth here that this is really expensive money. And here's what I mean by a myth. Absolutely. I've seen 40, 45, 50% rates with this money. But I've also seen 8, 10% rates. And the reality is, if you get an SBA loan right now, you're going to probably be at 7 or 8%. I've seen exactly the same rate with merchant cash advances. We even took out one of these as well. We do this with most funding we offer because we want to test it to make sure we understand it, to teach you and to actually have our customers understand as well. So for in our example, we did this about a year or so ago, and we did it to make some moves. We hired a business development person. We got into an office. We made about 3 major moves with the money, and it paid off big. The investment back into the business, we paid it off within the 6-month time period, and it helped us grow substantially. So, and we got a pretty good term on it as well, below 10%, because I have good credit and because our bank statements were solid and everything else was good. So look, risk is based on interest rates are based on risk. If you have a higher risk borrower that's getting 30, 45%, their bank account management's probably not that good. They might not be in a favorable industry. Their credit's probably not good. There's factors that make them higher risk. They could still get it, but they pay more. But the great thing is that if you have somebody like our situation, bank account management's good. We don't overdraw our bank account. I have good personal credit. I wasn't afraid to provide a PG for the actual loan in this case. Then again, which by the way, we have these loans that are available with no PG as well if you have a lower risk borrower. So in that case, you could still get lower rates. So rates do vary because risk varies. And whatever you pay fee-wise is 100% tax deductible anyways. So what it comes down to is, and this is what I always say about interest rates, does it make sense? I had a teacher of mine from high school that was looking for money, and he needed money to get through a rough season. He knew he was going to have a slower season ahead. And I said, you could qualify for this, but it's absolutely a bad fit because the rates are very high. 2 weeks later, he was on Facebook complaining about how somebody was trying to gouge him on price because somebody else offered him this loan because they didn't care about his situation when I did. The reason I say that is because, again, what happens here is that it has to make sense. In his situation, nobody should have ever presented him the loan because you don't get this kind of money just to get through a rough time. You use it to reinvest into the business for growth. And if you do what we did, which is increase the revenue by 30, 40% just by investing the money into growth, then it makes sense. We've had people that have a soft drink and brought the manufacturing in-house, for example. Their rate was really high because the risk was high. But the great thing is that they saved so much money bringing the manufacturing in-house. It made a ton of sense for them to do so. So again, it really comes down to whether it makes sense or whether we offer this and whether it makes sense for the customer to go with it. Can't be currently in bankruptcy or have recent liens. You've got to have about $10,000 a month in revenue. We do have lenders that will go down to about $5 a month in revenue if there are other compensating factors, 12 months in business, and we can go down to 6 months in business if the person has some kind of compensating factors. But 12 months and 120,000 is what's pretty common. You need to have consistent deposits. It can't be a real estate agent that has 10 grand a month because they do 2 deposits or 3 deposits. If that happen, a lender says the lender cares about monthly deposits and these type of things because they're going into the bank account to get their payment pulled out. So they want to make sure the money's there to pull out. So if somebody only has 2 or 3 deposits, well, then what the lender says is, well, what if 1 or 2 of those doesn't hit next month? Then will the money be there for us to take our payment? Probably not. So they want to see 6 or more deposits in a month, less than 10 non-sufficient funds where they're overdrawing the account, and a positive ending bank balance at the end of the month. Okay, so these things are important. If you think of it logically, a bank is just looking to make sure that they're going to get paid back. Somebody that's overdrawing the account doesn't even have enough money in the account day to day to pay what's going out of it now. Somebody that doesn't have consistent deposits, somebody that's negative at the end of the month. These are not indicators that somebody's going to consistently have the money for the payment to come back. And this also pays you more than almost any other program we have, about 3 or 4 percentage points. So when somebody gets a $100,000 loan, then you could earn $3,000 or $4,000 on that $100,000 loan. So it's fast, it's easy money, and then it also pays you really, really well as a partner, which makes it one of my favorite programs personally. Some lenders now offer credit lines with this program as well. So what they'll do is they'll give them a loan, then they give them a $20,000 credit line. Usually lenders are going to want to see better credit for this to actually happen. There's not a lot of lenders that do it. If the risk is low on the deal, they'll offer the same normal loan at 12%. Then they go ahead and give them a credit line as well as that. And lenders often want to see tax returns if they're coming in and giving somebody that credit line. Okay, MCAs, merchant cash advances. The only difference between a merchant cash advance and revenue lending is merchant cash advance only looks at credit card deposits. Revenue lending looks at credit card deposits, bank deposits, cash deposits, every kind of deposit. So that's really the difference between those. So there are some industry restrictions, okay? But the good thing about working with us as a partner is that we do so much volume that we often get people approved when they wouldn't normally get approved, and we get them better rates and terms. So for example, we've helped probably more credit repair companies obtain this kind of money than any lender or any other person you're going to talk to out in the lending space, because we work with a lot of credit repair companies. We have a lot of pull. We've got a lot of these deals done. Loans are based on bank accounts, not total business revenue. Okay, so if somebody has multiple bank accounts, they're only going to use the revenue from one bank account, not many. There's no prepayment penalty, so if you want to pay it off early, you absolutely can. And it's also common for us to get first and second loans. So maybe we get somebody a loan for 12% of their revenue, then we can also get them a second loan with another lender at the same time that offers seconds. So there are first and second position lenders on this, a strategy that we use to help some people get even more money. So usually very fast to approve. Within 24 hours, we can get a pre-approval. Funding can happen in as little as 3 days. Look, on almost every kind of business loan, it's the borrower that determines the time based on how quick they are. If you want to get your customers the fastest money, you need to tell them our finance team is going to be calling. They need to be expecting the call. They need to be prompt to respond to the call when it comes in. They need to be prompt to get us the documentation we need. It's usually us waiting on them to send us documents that slows down the process. Anybody that owns more than 20% of the business, the lender is going to want to look at the credit as well. SBA, surprisingly, we've been doing more of these than I ever thought we would do, okay? But you need to be in business 2 years or more and have tax returns. Those tax returns need to show a profit, and the person needs to have pretty good credit. SBA says 620. We see 680, 700 is really what it's going to take for somebody to get approved. If they have derogatory items, it's going to be pretty tough. The tax returns, they're going to want to see a profit on the tax returns. They're going to want to see positive growth, meaning the tax returns are showing revenues increasing year to year. Guys, it's tax time. So I'm going to tell you one of the best tips anybody's ever going to tell you when it comes to getting a loan or a credit line. Show some kind of profit on your tax returns. Believe it or not, if you come here with a 680 FICO score and tax returns that show no profit, your options are pretty limited when it comes to business funding. But if you have a 680 credit score and tax returns that show even $5,000, $10,000, $20,000 in profit, the whole world opens up to you. Lines of credit become available, SBA becomes available, term loans become available. So much of the best funding you're ever going to get is based on you having tax returns that show a profit. A buddy of mine owns a credit repair business. He just got an SBA loan. Only guy in credit repair I've ever even met that got an SBA loan because he's got tax returns that show a profit. So even though your accountants and all these people say to write off everything at the end of the year, spend as much at the end of the year, you need to know that when it comes to loans and credit lines, it will prevent you from getting money if you don't have those profits. So something you should know and you should teach your customers as well. Okay, so lenders want to see that the use of funds makes sense. So SBA, unlike other loan programs, they're going to want to know what you're using the money for, and the use of funds must make sense. Okay, SBA also has what they call cap lines, which is their credit line program. It's their umbrella program that they use to actually describe all the credit lines, loan amounts up to $5 million. And SBA qualifications about the same. We'll talk a little bit more about qualifications. So they have a seasonal line for people in seasonal businesses. They have a contract line, which works great for direct labor, material costs, basically associated with contractors. They have a builder line that's good for general contractors or builders in the construction industry for, again, direct labor, material cost. They also have a standard asset-based line for, it's kind of basically people that have to do with short-term assets. That they're actually, it has to do with how they're getting paid. And if they're getting slow paid, basically, this is a good option. And then a small asset baseline, which is very similar to what I just showed you, but the loan amount's not as high, so it's a little bit easier to get. So with all SBA loans, what you need to know is that all 3 C's are going to come into play. We're dealing with somebody that has a 680, 700 score. We're dealing with somebody that has tax returns that have a profit. They have good revenue. Their bank statements make sense. They're not overdrawing that account. And then they also typically have some kind of collateral. Now, with SBA, lenders will even use the person's home as collateral. So they'll typically take all business assets as collateral. And then they'll typically then look at the person's personal assets, stocks, bonds, 401k, even home, to collateralize the debt. So if you got somebody with good credit and good cash flow and good tax returns that also has some kind of collateral, well, we are successfully getting these deals done with SBA. So it does happen. You just have to have somebody with all 3 C's to actually get approved. So term loans. 620 FICO required, 700 scores are preferred. What do I mean by this? What I mean is that we have lenders that will go as low as 625, but there's not a lot of them. A lot of them will go at 680, 700. So we can still possibly get the right scenario done with the 625. We've done it before, many times before. But if they higher the score, the easier it is to get these. 1 year in business is required for these, 10,000 monthly in revenue. And you're going to want to have tax returns that show a profit. Even if you have 1 year's tax returns that show some kind of profit and pretty good credit, you're going to get somebody approved. Now, let's look at these criteria. If you have somebody that's got a bare minimum of 625 FICO and $2,000 in profit, that's a tougher deal to get done. But if you got somebody that's 625 FICO and 50,000 last year for profit, it's easier to get done. So these are called compensating factors. If there's a factor that's pretty strong on the deal, good industry, good bank account management, great tax returns, great credit, then one of those can be a compensating factor if another factor isn't as strong. So basically, you need pretty good credit and financials for approval with this. But if you have good credit and financials, then the whole world opens up because there's a lot of term loans at pretty good term or pretty good rates out there. So again, you can get loan terms up to about 30 years. You can get loans in the millions. 8 to 15% rates are pretty typical as well. So term loans, what are term loans? Term loans are longer term loans. Ultimately, it's what they are. They're, instead of revenue lending, which is only 1 year, 2 years, 3 years max, these are 3 years, 5 years, 10 years, 15, 30 years for higher loan amounts of money. So with lower rates and longer terms, being term loans, longer terms, lower rates, the payments are more affordable. So these are the preferred kind of loans we all want to get. But a lot of these are coming from alternative lenders, not SBA, for example. So there's a lot of alternative lenders that we're working with, the funding circles, the lending club, these type of lenders that offer these kind of term loans. Even we now are part partnered with Lendio that even works with American Express directly for these kind of loans. And again, could tell you all these lenders, because a lot of them are now closing the doors. They're only going to work with super brokers that do a lot of volume. The benefit is that because we do so much volume, we can have access to all these lenders, which means more term loans, which means more of your customers have the ability to actually come in and get approved. So a lot of new credit lines we've recently added, one of which is called an account receivables credit line. Now, you should be familiar with account receivables. If you're not, I'll explain to you real quickly what it is. Account receivables is basically somebody owing you money. It's as simple as that. But this new AR credit line, it doesn't even matter if it's a person that owes you money, a consumer, or it's a business or the government. So this could be anybody that basically brings you in and pays you over time. We are an example of this, right? We have account receivables because we let our customers come in and pay us over 6 or 7 months. So that money that's still due is called account receivables, and we can qualify for account receivable financing. So anytime you have people that pay you over time, then that's what AR financing is. Now, with this new credit line, the lender plugs directly into the accounting software. Actually, I shouldn't say that we've got multiple lenders that actually do this. They plug right into the accounting software, such as QuickBooks, or we use Xero. Rates are really cheap per week outstanding, about 0.5% to 0.7% per week outstanding. Okay, usually it's less than 5%, it's like 4.8% over a 6-month term, for example. That's the equivalent of about $50 per thousand borrowed. So I like this because, again, if you don't need the money for a long period of time, you won't pay a high rate. A buddy of mine that's in credit repair needed some money. We got him this credit line, and he paid it off within 2 weeks. So he only paid 1% on his money. So a really good benefit, and it's a true credit line. So the payback of 12 to 24 weeks, we now have lenders that will go as far as 12 months with this program. So they give you a credit line. You could pay it back over time. You just have about a year to actually pay it back. And there's no prepayment penalties if you pay it off early. Now, there's no consumer credit checks. We've got at least one source that does no consumer commercial credit checks. There's not even an inquiry on the credit report. We've got another lender that we just added that will do this program with a 620 FICO score. So low to regardless of credit, we've got options. They can't have a bankruptcy within the last 2 years. We did find out that the lender's basically looking at public records for this. We were able to verify that. So they're not pulling a credit report. They're just actually pulling public record. Really fast funding with this. This is a loan program we now offer to everybody. Anybody that's got revenue, we try to get them approved for this program, because even though the approvals are oftentimes small in the beginning, unless somebody supplies tax returns, it's still pretty cool to have $2,000 to $10,000, $20,000, $30,000 in financing with this program. Typical lines we've found are under 10 grand. The lenders don't say this, but all of our approvals have shown that they tend to like to give people lower approvals in the beginning, under 10. And then usually if you have tax returns and higher revenue, then you can get upwards up to $100,000 in credit line. Again, we tested this, and what we did was we approved initially for less than 10 grand. We supplied our tax returns. They gave us 30. Then we waited 6 months. We used it a little, and we applied again and resupplied our tax returns, and they gave us 100. So no credit check. So I love that, because I'm sick and tired of inquiries on my personal credit report. So there's no inquiry, no credit check, and we actually successfully secured 100 grand on this program. So it works really, really well. And we have that money available whenever we want, and they don't have any fees they tack into that. So this is why we run almost all of our clients that have revenue through this program now, because through one of our lenders, because especially the one where there's no inquiry on the credit report, there's no fees you pay to get the line. You just get it and have it available for you. Heck, why not? It's at least available for you if you need it. And high-risk industries are accepted too. They don't care about risk. What they're doing is plugging into the accounting software, and if they see that you have AR, the AR is getting paid back. That's primarily what they're looking at. Now, there's also another one that's basically the same thing, but it's based on revenue. So what they're doing is plugging into the bank account, typical line under 10 grand. You can get up to 100, but they're looking at the bank account instead. So there's a couple ways you could do this. We have multiple lenders that do it. They'll basically plug into your bank account, and they're looking to see, again, do you have positive ending balances, good bank account management. The same thing as revenue lending, but the rates are much better, and it's a credit line. And if you have good bank account management, you'll typically get an instant approval. And again, if you want to supply tax returns, you typically can access even more money. We've seen also people get instantly denied just because of bank mismanagement. So if somebody's mismanaging their bank account, they're overdrawing it, non-sufficient funds, negative ending balances, they're not going to get this. They're not going to get any revenue program. But if they have pretty good bank account management, we might send them over for revenue lending and this program at exactly the same time. So again, no different than everything I just showed you. High-risk industries accepted, 48-hour funding, no bankruptcies in the last 2 years, no consumer credit check with some lenders. We have other lenders that will check and require a 620 credit score to be able to get approved. So everything's the same. It's just the difference is one of these looks at account receivables. One of them looks at revenue. There's two different ways to qualify for the same program. And again, we have multiple lenders that offer this kind of funding. And again, there's another option here where they can go up to 12 months. Funding's a little longer, about 72 hours, but very similar. So we've got multiple programs because there's multiple lenders that are offering these kind of programs now, which is cool. Okay, so again, in here on program 2 is a little bit different. That's the one they need 620,000 or 620 a month. They need 20,000 a month in deposits, and there's limits, of course, of non-sufficient funds, etc. So what they're ultimately looking for, what it comes down to is this: do you have somebody that manages their bank account responsibly? Yes. If you do, and they've been in business even a few months or more, we're still going to shoot them over to see if we can get them approved for this. If they have tax returns, they'll get approved for even more money. Even if they don't, they could typically get a credit line up to 10 grand. Is that a big deal? Yeah, because believe it or not, half of the people that we survey, or no, we don't survey, we ask them how much money they're looking for. Half the people that get the finance suite are only looking for 10 grand right now. And so that's why we send so many through this credit line. Doesn't pay you a lot, doesn't pay us a lot either, but it satisfies so many people are so happy just to get 2, 5, 6, 10 grand initially so quickly and easily while we're working on other funding programs for them. So again, we've got the unsecured business financing program, still one of my favorites, one of the most popular programs that we have today. And there's a couple different ways somebody can get approved. It's completely based on FICO. So we just looked at some revenue options, right? We looked at SBA, we looked at term loans, we looked at some lines of credit based on revenue. We also looked at revenue lending and merchant cash advances, all based on revenue going through the bank account or tax returns. Now we're switching to that second C, the credit-based financing. And there's two ways somebody can get approved, 650 or 680. If they have 650, which is considered average credit, they're going to get what's called standard credit cards. They're going to get consumer credit cards that report on the consumer credit reports. If they have 680 FICO or higher, or a guarantor with that score, they're going to get both business and standard cards, or they can choose. Usually these approvals give them a choice. You can get business cards, or you can get business and standard cards and get more money. The question becomes, does somebody want the most amount of money? If they say yes, well, then we go ahead and we get them the standard and the business cards. But maybe they don't care how much money they get. They just don't want consumer reported cards. They only want cards that report on their business reporting agencies. They get that option as well. So if we look at the personal and business both, they go 10 to 150 grand. How much you get really depends on how high your current limit is. You're going to usually get 5 times to 8 times the amount of your current limit. Kind of works like this. You'll get about 5 times the amount of your highest limit on business cards. You'll get up to 8 times your current limit on business and standard cards. So if the highest limit you have is 10 grand, you could get up to 50 grand in cards that only report on the business credit reports. If you have a highest limit of 10 grand and you want business and standard cards, you could get up to $80,000 in financing. So you can get more if you accept those standard cards as we talked about. Now, again, you're going to typically get a bunch more money than you're going to get on your own because they understand the order of credit card issuers to apply for, which card issuers to apply for, whether you go to Bank of America or a credit union, etc., to get the most amount of money. And somebody's got to have less than 6 inquiries in the last 6 months and utilization below about 40%, sometimes even 60 on the consumer cards. And again, there's about 5 different credit cards, credit lines. So it creates competition. And They get 0% rates for 6 to 18 months. They'll pay usually a 9 to 12% success-based fee. It's typically about 10%. 9.99 is what our lenders charge, and it's a success-based fee. They only get charged on what the person actually gets. The person could even roll the charge into the cards they get, which is what most people end up doing, and it makes a lot of sense. Remember, SBA's points on an SBA loan, if you're talking about the lender and the SBA themselves, is probably about 6 points to 7 points. So it's, a few points more than SBA, but this is no doc. There's no tax returns. There's no bank statements. There's none of that required for approval. Now, again, with the personal cards, they need a 650 score higher. The utilization is a little bit easier, about 50%. We've even seen upwards of 60%. Less than 8 inquiries on the personal credit report. And this really is one of the best ways to get money for a startup and can pay you up to 3 points. Now, the business cards are pretty much exactly the same. The difference is the business cards only report to the business credit reporting agency. So they build business credit while getting access to money. They're still getting 0% interest for 6 to 18 months, which is fantastic for a startup. It's no doc financing. They don't need bank statements. They don't need tax returns, those type of things. For example, you can still get about 5 times the amount of the highest credit limit account. Fees the same, but a little bit harder to qualify. You need to have utilization below 30%, and you also need to have less than 6 inquiries. I say 4, but it seems like I'm told a different number every single week, so I'm going to go with less than 6 out. Now, there are some changes to this program over the last 6 months. One, cash out is now available. So this becomes a hybrid program. They get 0% rates, which you only get on credit cards, not credit lines. You could take the cash out of the credit card at 0%, which you can only do with credit lines to take cash out. So you get the benefit of 0% rates for 6 to 18 months that come with credit cards. You get the benefit of taking the physical cash out on this that you get with credit lines. You combine those two, it's a pretty ridiculous program. You're getting rates at 0% for 6 to 18 months. You could physically take all the cash out of the cards if you want to, so they effectively become credit lines. You build business credit at exactly the same time. So instead of needing vendor accounts, you use these as your initial handful of accounts. So there's just a ton of benefits with this cash out option. And there's a rapid rescore. So the main sources we use have access to the credit bureaus and do soft credit pulls, which now means in a lot of cases we don't need credit monitoring to be able to get somebody approved for this. And if they need to pay down a balance, if their utilization is 37%, they need to be below 30. Well, then they can pay down that balance, get a letter from the credit card company, get the letter to the lender. The finance source of the lender will then actually take that letter, will send it into the bureaus, will rapid rescore them, and update their credit profile in about 24 hours to get them approved. So pretty cool. If somebody comes in and all of a sudden they need to pay down a credit card to be able to get approved, then what happens is they can rapid rescore and have that credit updated in a day versus then wait a month or 2 months. And here's the other cool thing. We even have a lender that will lend them the money to do the pay downs. It's the same one that does the actually issues the cards. So if the finance source looks at it and they say, well, you're at 40% utilization, you need to be at 30%. Well, then the finance source will even give them a loan to pay down the 10% they need. So then they have their balances low enough to then turn around and get the financing. So there's a lot of creative things we can do here. A lot of them even work with inquiry removal companies. Now, if you're in credit repair, great, you do it. But if not, well, then there's even some companies, even one I tested that comes from these lenders that works pretty well. And soft pulls, as I mentioned, are available as well. So it's easier to get this program than ever before. If somebody has only a 650 score, they can actually get a couple things now. One of these finance sources now offers personal loans. So that'll be an option that we offer them if that's something that they want. And a lot of people say no. A lot of people actually say yes to that, or the personal cards, or the people that are better with higher score, 680 or higher, then they're able to come in and be able to get the business cards even more. They have cash out capability, rapid rescore, soft pulls, loans to pay down balances, just more factors that make it easier to get somebody approved. And also keep in mind that guarantors are acceptable here. So if, grandma grandma, grandpa, mom, dad, business partner, business investor wants to actually use their credit to qualify, well, then it's pretty cool because the credit only reports on the business credit reports. So the business still builds its credit even though a guarantor is being used. And the guarantor, none of this credit shows on their credit report either. The only drawback, of course, is if that borrower defaults, then they'll come after the guarantor. So, it has to be a trust relationship where the guarantor and the borrower know each other, like each other, trust each other to do this. Because I get this crazy question all the time of, do we go out and get guarantors for people? No, we don't. If you don't have anybody that even trusts you enough to be a guarantor, then that kind of speaks for itself. There's no way that we would actually do that for you. But if you have a guarantor, then it is a way to be able to qualify for this program. So we've talked about both C's. We talked about cash flow. We talked about revenue lending, merchant cash advances, SBA loans, term loans, lines of credit, all based on cash flow through bank statements or tax returns. We talked about credit. We talked about some actual personal financing that'll be available to them, consumer credit cards that they get as a multiples, 5 to 8 different kind of credit cards, credit lines. They can take cash out, even business credit cards where they could build business credit and still get credit lines or credit cards with cash out capability, basically credit lines at 0% for 6 to 18 months while building their business credit. And they have to have good credit for that program or a guarantor with good credit. Now we move to that third type of financing, which is called collateral-based financing. And collateral-based financing works with pretty much any type of business collateral we've seen, or some types of personal collateral. Like some types, I mean, like your trailer that you use to tow your mower will not work. I know because we tried. So some things like that won't work, but the business collateral many times typically will work. So account receivables, other people owe you money. Purchase orders, you need to get a purchase order filled. You need to go buy supplies to fulfill an order. We can get financing for that. Book a business if they're an insurance agent. Equipment to buy, lease, or borrow against equipment. Inventory to buy or borrow against equipment or inventory. Commercial real estate, even residential real estate if somebody's a house flipper, somebody's flipping homes, which we'll talk about. Even commercial vehicles, which we've added last year, where somebody wants to get financing to go out and buy 18-wheel trucks, or somebody wants to come out and get money to buy an ambulance or a bus, for example, then we have that kind of financing as part of this collateral as well. Now, some personal collateral could be stocks, bonds, 401ks, IRAs, or residential property. If the purpose is to flip the property, then those things can be used as collateral as well. Speaking of flipping property, somebody can get 100% of the money they need to purchase and rehab a property through our house flipper program. Lenders are usually going to lend up to 65% of after repaired value. So if you bought the house right, you could get all the money you need to buy it and fix it up. You just aren't going to be lent more than 65% of what that property is going to be worth after it's all fixed up. Usually 6-month terms, because you're flipping a property. The lender is expecting you're going to fix it and flip it in 6 months. And if you don't, well, then you just pay them a little bit more money and they extend the term from what we've seen with experience. Rates are 8% or higher. I don't know why they call this hard money, because like 8% rate doesn't seem like it's high to me. But it is considered hard money lending for real estate investors. But real estate investors or flippers are a high risk industry because everybody wants to get into it without experience. So you have to have about a 660 FICO for approval. You got to have flipping experience too. So you have to have at least 2 to 3 properties you flipped within the last year to get approved. And you got to have cash in hand. As a matter of fact, they're going to make you put money into the bank account. So you're going to have an escrow account. So you're probably going to have at least 30 grand cash in hand to put into the deal, into an escrow account to secure it. So most people you talk to aren't going to qualify here. And here's why. Everybody wants to be a house flipper. Everybody does. And so most people that have bad credit, no flipping experience, no cash on hand, those are the ones that usually want these loans, and they're not going to be the ones that'll get it, because you got to have average credit, some flipping experience, and cash on hand to get into this program. And if you have all three, it's a great program because you can even buy multiple homes at the same time to flip. So you're using real property, consumer residential property as collateral. Funds in a house for seller program are usually available for short-term residential purchases and renovation. Most traditional banks and credit unions are not going to approve these. Okay, none of them. I don't say none, but it really should say none. Authorized money is held in an escrow account, and it's released in draws. If you've ever had a construction loan, it's exactly the same way. With a construction loan, they lend you money, and then it goes into an account, and then every stage of your house that's built, the money gets released to those people once the work is inspected. It's the same thing here. They took the money, they put it into an escrow account, and then what happens is you come in, and then they complete a part of the flip. There's an inspection to prove it's done, and that money's released to those contractors. So it's a way of releasing money to the contractors doing the work, so it can be released as the work is done. And Demetrius, Ty, can you use an existing commercial 18-wheel truck as collateral if the person has under a 600? Typically not. If somebody has a 650 to 700, we take a shot with that to see if it's done. But somebody that has less than a 600 score and owns the truck to borrow against to get cash, that's going to be a tough thing to do. That's probably not going to happen. But if somebody had better credit, Demetrius, in that scenario, yeah, probably work. But a refi on a truck is hard to do to begin with. A refi on a truck with bad credit is really tough to do. This is account receivable financing, although my thing says house reseller for some reason. Let me go ahead and see if I can change that thing real quick here. I'll see if I can just change that real quick here. House flipper. House for seller. Okay, AR financing account receivable financing, and fix it on the fly. Okay, so this is something we already talked about, where receivables are used as collateral. We can now have lenders that will go up to 90%. In the past, it's only been 80%. So remember what AR is. Account receivables, when people owe you money and usually pay over time. I use the same example because it was one of my first clients I ever sold the finance to. He's a buddy of mine. He owns a factory, and he does the plastic mugs for Busch Gardens. You know, the cups you spend like $10 for because they're like a dinosaur look or whatever. He makes those. Well, when he gets a huge order from Busch Gardens, he has to fulfill that order. He has to pay his staff. He has to buy all the plastic and run the machines and get them the cups. Then he waits 2 months to get paid. Well, with AR financing, he could get up to 90% of the money advanced to him within 24 hours. And then the lender actually goes to Busch Gardens in this example and collects the invoice. And once the invoice is paid, the other 10% minus the lender's fee is advanced to him. The fees are usually pretty low, 1.25% to 3% per week outstanding. So it can get expensive if somebody waits a long time to actually get paid. But if it's a shorter period of time, it could cost them less money to do this and accept credit cards from those same customers. No credit score requirements. They don't care about your consumer credit, because instead what they care about is the credit of the actual company that has the account receivables with you. It's them that they're worried about paying, not you. So again, receivables must come from another business or government agency. I told you about some credit lines where they don't care about that. But most of the loans with this, where they just give you the 90% of the invoice the next day, they do want you to be a business 1 year. It does have to be a business or government agency to qualify. There's something that are called conventional receivables, and then medical and construction. Those are the biggest industries. And if you think about it, it makes sense, because if you are a contractor and you go to U.S. Homes, it's building homes, you're going to wait a while to get paid. They're not going to pay you usually until the house is done, complete, and sold. And so because of that, you wait a long time to get paid. So, and the same with medical, right? If you're a doctor, apparently Medicare, Medicaid, and health insurance don't pay you quickly. So because of that, medical and construction are very common industries for this kind of financing. But medical is the only one that has a restriction of how much you have to have in receivables, and it's about 600 grand. So somebody has to have about 600 grand to even qualify to get financing for through AR if it's medical, but there's no requirement for conventional or construction. And with this one, you're not going to make a bunch of money in points on this deal, but you'll get paid recurring money. So every month, man, we have tons of these things that come in. It's weird. Like we have just checks for 50, 100, 200, 1,000, $2,000 that come in regularly every single week or every month. That's what happens with this. If you're part of our executive program and you get paid on funding your customers submit, then what happens is you're not going to get a big chunk when the deal funds. You'll just get ongoing recurring money every time that they submit more receivables. So purchase order financing for $5,000, there's really no cap to this. You can get up to 95% of a purchase order advanced to you. So a purchase order is, for example, let's say that my buddy in the example I gave you, that he needs to buy the plastic to fulfill the order for Busch Gardens. Well, then he would be able to come in and get the money he needs to buy the actual stuff that he needs to fulfill the order. I always use a t-shirt embroiderer as an example. You're a t-shirt embroiderer and you get a huge order. You have to go pay for those t-shirts. Well, before you can embroider them. Well, with PO financing, you could get up to 95% of the money from a bank to buy the t-shirts. Then you embroider them, then you sell them, then you pay the lender back. So it gets you the money you need to fulfill the items. Pretty low rates on this, 1 to 4%, no credit score requirements. And what happens is they're issuing a letter of credit. So they send the supplier a letter of credit stating you ship the items, we pay you. They ship the items, they get paid. And then what happens is the lender then gets paid once you fulfill the order and sell whatever it is you're trying to get the supply or the inventory to actually turn around and sell. Cannot be unfinished goods, and it's pretty simple to get approved for this as well. Most of this kind of stuff will pay you 0.5% to 2% because we don't get paid a lot. And if you're part of our executive program, we're basically just splitting with you the fees that we actually get. So book of business financing is where commissions from an insurance agent's book of business classify as collateral. Somebody's getting a 3 to 10 year loan, about 4 to 9% plus the prime rate. Pretty decent credit, 520 score to get approved. And somebody can get as much as 120% of surrender value. Basically, if they were going to close their agency down and sell back their actual book of business to Allstate, for example, then whatever they'd sell that book of business for, surrender that book of business for, they get 120% of that value. State Farm doesn't own their book of business, so they wouldn't qualify for this program. But it's a really good program. I've told you before that in almost every scenario I've ever seen, people always want more money than they can get. This is this is the one kind of loan product where to date, every single person we've approved has taken less money than we could have got them approved for. The approvals are so high with this kind of financing that a lot of agents get well more money than they need. You can also get the money and use it from a book of business from an agency you're buying, which is cool. So if you want to go buy an insurance agency, you could use their existing book of business to get a loan and use that loan to buy the agency. It's actually commonly used for that purpose. So to get money by an existing agency or to get money to buy an agency, it could be used for. Equipment financing, startups can qualify 10,000 to 20 million, 12 to 24 month terms, rates of 5 to 55%, works with all kinds of credit. Okay, 580 or higher is pretty standard. 650 is preferred. You know, somebody's going to pay a higher rate if their credit score is lower, but if the better their credit is, the better the rate's going to be. You can get approved for a down payment as much as the first and last month's payments with this program as well. So, you know, this is what I like about what we do. We work with every legitimate kind of funding, so we can often get people more money that way. So one of my friends, for example, opened up this really cool practice I love where they basically run all the admin, marketing, advertising for doctors' offices. It's really a cool concept. And what we helped her do was get unsecured financing she used for payroll. She also used the unsecured financing to pay the first and last month's payment for equipment financing she was using to purchase a big piece of medical equipment. So that's kind of how we help people by combining these multiple different kind of loans It's not uncommon for us to get somebody a credit line for 10, 20 grand. Then we turn around and get them a loan, and they get another credit line or another loan. So this is what's nice about being able to combine all these different types of financing. Now, equipment leasing, somebody's got to be in business 1 year or more, same loan amounts and same terms, 12 to 48 months, 10,000 to 20 million, same credit score requirements, same down payment requirements. So equipment leasing usually wants you to have better credit and a year in business to get approved. Usually they're not actually going to go down to a 580. They usually want to see that 650 type score to get approved. Now, the third type of equipment financing is called equipment sale leaseback, and it's exactly what it sounds like. You're basically selling the equipment back to the lender, and then you're leasing it back from them. So usually you can borrow as much as about 50% of the value of your equipment. You can get this even as a startup, 10,000 to 20 million, 12 to 48 month term, rate of 55 to 55%. And you don't really have to have good credit with this either. So the way this program works is that you take an existing piece of equipment, you take a backhoe, you take a big piece of machinery that's in a warehouse. You use that as collateral. You own it free and clear, and you borrow it against it to get money. So we talked about three completely different types of financing with equipment. Money to buy equipment, you get even as a startup. Bad credit's okay. Money to lease equipment, you usually want better credit the year in business, but the rates and terms are better. And the third option is you already own equipment. You're borrowing against that equipment to physically get cash. And then you want to buy that, then you lease back the equipment. When you pay it off, the equipment's yours again. So a few different options here for anybody that's from a startup to an existing business. Inventory financing usually is about $500,000 in inventory you need to have. It's a line of credit, pretty low rates, no credit score requirements, and you get a line of credit for about 50% of the value of the inventory. So you have to have $500,000 in inventory or higher to get approved. To date, I've never seen anybody qualify this program. We just don't work with clients that have $500,000 in inventory. It's there if you need it, but it's not a program we've ever seen fund because we just never had anybody even come close to the $500,000 in financing. Demetrius says, Ty, I have a group of churches who buy AV equipment from me. What lender do we have for them, and will co-sign? Or yeah, we absolutely we have lenders that just work for churches. That's all they do is financing for churches. But we're still going to look at the same thing. What are their assets? What's the cash flow? What's the credit? What's the collateral to be able to get them approved? For example, AV equipment's not going to work because it's not one big piece of equipment, so it wouldn't qualify for equipment financing. Typically, it could, depending on the piece of equipment, but there's a lot of financing we have for churches and those off industries. Not to make a jump to the other end of the spectrum, but marijuana industry is like that as well. We have a lot of lenders that, aggressively lend in the marijuana industry, aggressively. The last approval I saw blew my mind. Usually we get somebody approved with revenue lending for 1 month of what they do in revenue, about 12% of their annual revenue. They got approved for 100% of what they do in annual revenue. I've never seen an approval so high. So there's really people eager to lend to churches and even people in these off industries like the pod industry, for example. So if you have those kind of scenarios, we'll talk in a few minutes here about how to get those submitted. Security, stocks and bonds is what this is. You can get up to 90% of the value of those lent over a 5-year loan or credit line. Pretty low rate, prime plus 2%, no FICO requirements. Most stocks and securities are accepted. And with this kind of financing, basically you're still earning interest on the stocks and bonds. It's pretty freaking brilliant, whether it's your stocks and bonds or somebody else that wants to invest in your business. So let's say dad wants to invest in your business, but doesn't want to take money out of his bank account. He can pledge his stocks as collateral. He still earns the interest on the stocks, but of course, if you default, then the stocks go away. If you don't default, you end up with a low interest rate loan or credit line, and you could maybe give him some equity in the business, for example. So it's your stocks, bonds, somebody else's stocks or bonds, a great option to go as well. Commercial real estate, 75,000 to 20 million, loans 55 to 65%. They're going to want full doc deal here. 2 years financials, tax returns, P&L. The business got to have, of course, the money to pay the bill back. 650 FICO score. They're typically, in almost all cases, going to need a personal guarantee. The interest rate's pretty low. So again, if somebody borrows against equipment there or a commercial real estate they already own, or use it to buy commercial real estate, we have options with both. We even have investors that will do multiple properties on residential as well with this program. So they have, let's say somebody owns 20 properties that are properties that they own and lease out. Residential properties, we have people that do blanket loans on those kind of properties as well. So there's a lot of stuff we can help. We can't help somebody get a loan to buy a house unless they're flipping it. We talked about that kind of financing. But if somebody owns 10 properties, 12 properties, 15 properties, and they want to put them all into one blanket loan, for example, we absolutely can do that. We can help them take cash out and do a blanket loan as well. So commercial and consumer real estate. And I've never talked about that consumer real estate program, but we do have it. And we've got some investors that kill it and do a lot of financing in that program. 401k or IRA, similar to the securities, the stocks and bonds, but somebody can get 100% of what's in their 401k with a 5-year loan or credit line rate, 2% plus prime. The lender will charge a $19.95 for this, and they roll it right into the deal. They do the same thing with the stock financing as well. And they have to own the 401k. If you have the 401k with an employer now, you can't, the employer usually won't let you use it for any other purpose. But in a lot of cases, if you leave an employer, then you have access to 100%. So you can get 100% of what's rollable, or basically what's not with a current employer, is what you can get with this. Commercial vehicle financing, get money to purchase commercial vehicles, buses, trucks, emergency vehicles, etc. You can borrow against free and clear vehicles as well. So again, a newer program that we've added where we've got all different kind of financing that will work for commercial vehicles, even over the road trucks. So of course, don't forget business credit. It's not really a funding program, but what I like about it is that it's the way to get somebody money if they don't have cash flow credit or collateral. So we have these conversations with people all the time. I want a loan. Well, you don't have any cash flow credit or collateral, you can't get a loan, but I can still get you business credit. Because remember, with business credit, they can get immediate vendor credit approval. Then they get to store credit. Then they don't have to have personal credit checks or guarantees. They can eventually get to fleet credit, Visa cards, MasterCards, Amex cards. Recently, we've had clients approved for PNC Bank for $100,000, Amex for 50, PNC Bank for 50 grand. None of these required personal guarantees or personal credit checks. So again, it's a really great option for somebody to go with if they can't get financing. They don't need financials. They don't need bank statements. The credit doesn't matter. It works for startups. It reports only to the business credit reporting agencies. The credit doesn't affect their personal scores. There's no inquiries on their consumer credit report. And of course, as you should know by now, the quality of somebody's business credit determines if they're going to get approved for loans in a lot of cases, and the rates and terms that they'll pay on the actual loans that they get approved for. So if you aren't already, and I'm going to show you this really quick. If you, sweetlogin.com, I think, oh my passwords got cleared out of here. So I'm going to show you really quick just some things in the finance suite that you should see when it comes to actually submitting deals for financing, because there's a lot of different options here for you if you're doing that. So remember, if you're an executive member, you know, it's $99 a month, and I'm not trying to sell you on our executive program. There's no selling necessary. That same thing used to cost over $300 a month that we give you now for $99. You get paid on funding that you close. You could submit deals for funding. You could get all this extra stuff, all the extra videos and resources and access to train your salesman and a bunch of stuff. So talk to our team. We'll talk to you more about that. But if you are part of executive, then you have some pretty cool options when it comes to funding. First of all, if you come to the add client section, if you're executive, then if you want to submit a customer for funding, you just come right over here to Finance Blueprint Qualify. And then we're just going to ask you a few basic questions. I mean, it's not many. We're basically just going to ask you the 3 C's: cash flow, credit, collateral. And then it goes right to our finance team. And one of our finance team, whether it be Craig or Doug or, you know, one of those guys is going to help you then get on the phone with your customer, determine qualification, and go in to get them financing. My advice is stay out of the way. You know, a lot of people want to be the in-between person between their customer and the finance officer, and it creates all kinds of issues. And then the partner tries to present terms. The deal never gets taken. I mean, literally, our closing percentage on deals we present terms to is 70% higher than when our partners present terms. It's insane why our partners even sometimes want to, but it's getting to a point where our finance officers just aren't even going to let you do it, because so many of the time the deals don't work because they're used to presenting these terms, right? So you just come in here, add clients, finance blueprint qualifier. You answer some questions. You even say initial contact. Do you want to be contacted first? Do you want the client to be contacted? And you basically enter a little bit of information, goes right to our finance team. Our finance team reaches out to the customer, determines all funding programs they can qualify for. We talk to them about the funding they can qualify for, answer their questions, talk to them about rates, terms, lender fees, et cetera, et cetera. Customer says, yes, I want to move forward. Our finance officer then moves the file into processing, and our processing team works with the customer to get any documents we need, applications, bank statements, any income docs we need. Once we get what we need from the customer, we submit to the lender. We get formal approval or denial. If we get formal approval, the finance officer gets on the phone with the customer, presents rates, terms, goes over it, gets the deal closed. And then when that deal closes, you get paid that Friday. It's that simple. I think if I get funds before Wednesday by end of day business, you get paid Friday. We ACH the money right to your bank account. You're typically getting about 50% of what we make. It's what we make. And I'll show you how to figure out how much you're going to make per deal here in a second. So it's super simple. Somebody doesn't qualify, then what we're typically going to do is figure out the reason why. We usually learn something there we didn't know through the denial. And then what we do is we choose another lender and send it to them. And we have lenders that deal with high risk, low risk, medium risk with most funding. So it's super simple to add somebody, add clients, come right here to add client, direct funding, finance blueprint qualifier, and submit them. Now you can also track other things here as well. So as you come in here, I don't think I even have it turned on, because don't see my commissions. But usually there's a commissions here, which I somehow cannot see here. But there's a commissions here where you can actually track your clients. You can also come to client dashboard, and client dashboard, I have a bunch of test clients here. Client dashboard will give you access to a bunch of test customers. So let me go to this customer, for example, here. So it gives you access to this, and you can see all the information in their finance blueprint qualifier here. You can see the finance stage the customer's in here. You can also see the notes for the customer here in real time. So whenever we reach out to the customer, we update our notes. Your notes are our notes. And we do this because there's no way our finance officers can talk to a customer and then talk to you and tell you what happened every single time. It's impossible because they talk to so many customers. So what happens is when they talk to a customer, they leave a note in their system and it updates here in real time. So by going to the client dashboard, you can track all the information they entered. Nobody's entered anything here, but you see how I have this information for business credit. This populates in real time, so you can see all the finance questions, so you can see if the cash flow credit collateral they have. You can click here, see the finance stage that they're in here too, and you can also come in here and see your notes. So everything in real time gives you the ability to actually come in here and see this. So here's, for example, a test client. You can see more details. You can see here the finance stages. We can see that the person actually funded. We can see all the information they entered on the finance blueprint qualifier. So it just gives you access in real time. As they fill this out, yours populates in real time. You can see it. As we leave notes in real time, you have access. As we move them through stages, you can see it in real time too. And I don't have it here, but usually you can come right here on the left-hand side and click commissions and track your commissions as well. Now, if you are the executive program, you can also come in here to finance resources, and there's a bunch of other stuff that you probably want to see. There's a finance program cheat sheet, and this cheat sheet gives you a summary of our main funding programs. So you can see each program, rates, terms, you can see credit requirements, you can see details. Our finance officers have this up in their desks as well. So you can get kind of an overview of the actual cheat sheet, or a cheat sheet of the actual finance deals. Now we also have a full funding guidelines document here, and it's like the funding program cheat sheet. It's just much more elaborate. this has a lot more details per program, what income docs we need, what can exclude them from getting approved. So between the funding guidelines and the funding program cheat sheet, there's a ton of information here on funding programs. There's also the finance commissions, W-9 ACH forms. So we've got to have your tax documents to pay you, obviously. And you can get all that information right here from the back office as well. So you can come in and submit your information right through here to make that easy and convenient for you as well. And this is a finance commitment letter. This is something I made that you can actually use to basically get your customers signed up. You're basically getting them to give you permission. It basically says they're going to buy the finance suite from you if you get them funding first. Remember, if you're executive, you can submit customers for funding without them ever buying the finance suite first. And this is a commitment from them to buy the finance suite if you do get them funding. So it's a good way for you to get them funding first and then get commitment from them to actually buy for you if you do get it for them. Here's a funding process outline. So this funding process outline here in Finance Resources basically gives you an overview of the funding process, and it even tells you what can affect the process. So we talked to you about each step. We talked to you about the average time frame for a step. We talk about possible delays in every step. So we give you a really good breakdown of exactly what happens every stage of the process, what can cause delays, what you can do to make sure we don't have delays, etc. So by looking at notes and looking at things like the funding process guidelines, then it really, or the funding process outline, it just tells you what to expect. It's just as simple as that. And then here's the funding commission schedule. This is on average what we typically see that you'll earn, for every funding program. So if you're submitting a funding program, gives you an idea. We're splitting revenue on, I guess, at almost every program we have. We split revenue right down the middle. So we split it 50-50 with you, which is the highest payout anywhere. And you can see here just what kind of funding programs pay what commissions. So you can see our funding program commissions, and that's right under funding commissions. And again, I'm right here under finance resources. If you don't have this, it's probably because you're not executive. And funding commissions and finance marketing videos, marketing flyers. And this is the stages that they're in. So again, I told you what stage that they're in. This tells you what stage they're in. So even though you can go into their record and track their stage, this tells you what the tracking is. You can see this is we received the file. These are the stages that we have all the way to funded a completion. So you know what stages we're actually looking at there. And then you can also come in as executive and get all kinds of marketing resources, including these are all videos just about funding programs that we offer. And these are all available for the different funding programs. And then we also have a bunch of flyers that are funding program specific as well. And that is obnoxiously big. So you can see here 401k financing, account receivable financing, et cetera, et cetera. And these are all customizable. So these are all per funding program that if you're executive and you want to market certain funding programs, then you have those available as well. So there's just a ton of resources here in the back office when it comes to financing resources. So your cheat sheet, quick overview of funding programs, the commissions, the W-9, this helps you submit the income docs to get paid. Finance commitment letter gets commitment for them to buy if you submit them for funding first. Funding process outline explains the process, and the funding finance stage key gives you an idea of how we track it in our stages, so you'll know what stage somebody's in. And you can also see the guidelines with more details, explanation of each funding program, funding commission, which breaks down your commissions. And then you can also see here videos and marketing flyers here as well to be able to market. So, and again, pretty simple. Add clients, come over here and go to direct funding, submit the information, and you're off to the races. The finance team does the rest. They'll still communicate with you. Again, you still have notes available in real time, our processing team, etc. And you probably already know that team's expanding, right? Doug, many of you talked to Doug, many of you talked to Daniel, many of you talked to Rick. Those are just 3 of our new finance officers. We're getting ready to hire a new full-time processor, and we're also placing somebody whose whole role is just to get us new lenders and place deals. So it kind of gives you an idea of how that works. So if you have any other questions, go ahead and type them in. I want to make sure that I get all your questions answered. If you're not executive, just get with our team. you can go to support@creditsuite.com to ask. They can talk to you more about it. Executive makes a ton of sense because it's only $99 a month if you have funding customers or if you have salespeople you want to onboard. If you have either one of those, then it's a no-brainer. If you're not to a point where you have either one of those yet, you probably want to hold off. That's my best advice. But our team, support@creditsuite.com, will answer those questions. And of course, you can call our main number. Go to creditsuite.com, just call the number on our website, and then you could talk to our team as well, and they could answer any question you have, or any emails you get from us, which should be probably nearly daily. Then you're going to get an email with support's direct phone number as well. So if you have any questions, let me know. So if you have any other questions we haven't answered here that I don't have typed in, then let us know. Give us a ring, send us an email. We'll talk to you more. We are adding more lenders. Again, we just added Kabbage. We just added Lendio. We just added Funding Circle and Lending Club and all of these other lenders because we've got our volume high enough now for all these guys to let us in. Some of them were only one of 5 or 10 brokers they even deal with. So it's opened up a lot more funding options, a lot more term loans, a lot more lines of credit, SBA loans, things we didn't fund a lot of before, which we're now funding on the regular. We funded a $350,000 term loan last month, a $195,000 revenue deal last month, a lot of others. We had, I don't even know how many fundings, but millions of dollars in fundings. So we fund a lot. You get paid about half of what we get paid, or basically half of what we get paid on every deal. So it gives you an opportunity to earn good money just by submitting somebody for funding, or even by selling them a finance suite, and then they get funding out of that. As long as you're executive, you're getting paid. So if you have any questions, please let us know. This is a good overview of all the funding programs: credit, cash flow, collateral, the 3 C's, how to submit customers, how to access financing, training resources, market resources in the back office. Boom, that's pretty much it. So anything else? I don't have any other questions here. Let us know. 877-600-2487. Call our support number or send us an email at support@creditsuite.com. Thanks, everybody. Have a great day.